Okay, good morning. I'm George Calhoun, wherever you are, or good afternoon. I run the quantitative finance program at Stevens Institute of Technology, and I'm going to talk about the impact of the COVID-19 crisis on the financial markets. I want to start, though, by showing you in the paper today, just now, probably the most astonishing chart you will ever see in your entire life from the perspective of the financial world. Here it is. This is the price of West Texas Intermediate oil for May delivery. And this afternoon, a little bit before I began this video, it went below zero. They are paying people to take oil. You remember when oil was $100 a barrel, $120 a barrel? Here you are, negative pricing. And the second most astonishing chart you're going to see is this one, which shows that that's for May delivery next month. But in November, if you want to buy oil for November delivery, you're going to have to pay $30, $35 a barrel. So something very unusual is happening, and we are going to talk about it. I'm going to bounce back and forth between the talking head portion of what I'm doing and a number of graphics, charts. I'm going to try to go at a level that's comprehensible to pretty much all levels of the audience, but there are some of these charts are pretty technical. I'm not going to dwell on the technical aspect. I'll be making very general points. Anyhow, let me jump in. So if you think about the stock market, you may start by thinking of it like a supermarket. There are products, and here, if you'll bear with me, I have my graphic. So you have a supermarket that is got lots of products on the shelves, and you probably started out before you thought too much about it or got too much experience with the market. You probably would have had a concept kind of like this. Here is the shelf. Here are the different products, the stocks that are available, and they have prices, and you can go and look at them and kind of decide which of those stocks you're interested in purchasing, just like you decide which type of, in this case, cookie you're in the cookie aisle or the coffee aisle or whatever. That is not what the financial market is like. Financial market, on the contrary, is a computer. That's the best way to think of it. It absorbs, sucks in information from all over. Information about the economy, information about the Federal Reserve, information about which companies are in trouble, the financial information that they report, the general background of opinion about the market, and of course, whatever's happening in the wide world. In this case, there's a virus and a pandemic, but we'll get to that in a minute. The point is that the market takes in all this information and outputs a signal, and the signal is the price. And the price is full of information. It's very hard. It's hard to interpret sometimes. Sometimes it's not so hard to interpret, but it's full of information. And this is something that the grocery store or the supermarket isn't doing. The products on the shelves in the supermarket are not generating information for you in that way. The market, the financial market, is a computer, and it's a computer that has amazing powers, I think. If you consider, say, Ford Motor Company as a stock, Ford is, there's a lot of information that's relevant to Ford, the labor situation, the competition, the regulatory picture, mileage, fuel economy regulations, all kinds of regulations. And of course, the Federal Reserve is doing things that affect Ford's business as well, et cetera, et cetera, et cetera. So Ford is, the computer is taking all this information and processing it and giving you Ford's share price. And I'm not going to dwell too much on this. It's an amazing thing when you really get into it, how the market is very, very sensitive to information and does some amazing things with it. Now, what is happening to us today is that we have entered a very unusual moment in history, and financial and economic history. And actually, the chart I just showed you, the oil, is probably the most amazing chart that I could bring up. But I have a couple that are queued up here. This is the jobless claims. You probably are following those. They're in the headlines. Jobless claims typically ran a couple 100,000 a month. You can see very flat levels. And all of a sudden, it's in the millions, 6 million a month. And this has never happened before. And it's something that indicates a degree of what I'm going to call nonlinearity, too much information. Nonlinearity is an engineer's term. Here's the same picture showing a little bit more of the history. This is from the previous recession, and it comes down and down and down, and then pop. And that nonlinearity is what's driving people crazy, because we have today a case of a shock to this computer. The computer is not unbreakable. There have been moments where it seemed like it might be about to break. We had a number of circuit breaker stoppages of trading in the market in the past month, unprecedented. There have been glitches and flash crashes and other problems. The market is pretty robust, and it's getting more robust all the time because technology is making it more robust, but it is still capable of being whacked. And when something as powerful as the coronavirus pandemic strikes the economy, it's kind of like ringing a bell. And what starts to happen, here you can see it. I hope you can see me. Yeah. This is a chart of the daily movement of the stock market, basically up and down. The reds are down days, the gray are up days, and up through about until March, you have a pretty typical pattern. There's some fluctuation. This is called volatility. The up and down scale, the movements in the market is what the professionals refer to as volatility. And you can see here in March, when the coronavirus pandemic really, I would say, became something that people began to realize the scope of it, it was like a hammer hit a bell, and the bell started to ring, and it went up and down and up and down. And you've seen, if you track the market, there have been down days, enormous down days, 1,000 points, 1,200 points, and followed quite often by enormous up days. If it were all down, that'd be one thing, but if it's down and up and down and up, these violent movements, this is volatility. And the measure of volatility here is this blue line. It's something called the Vix, the Volatility Index. It's a technical metric, but it's become quite popular. And this point here, about 82 on the measure of the Volatility Index, was the all-time, I think that was on March 16th, it's the all-time high. The typical VIX level in normal times was between 10 and 20. It had been that way for a long time, and the explosion of volatility drove it to a new record as the market kind of fell to pieces under the impact. However, I'm going to make 3 points about this whole situation that I find interesting. One is the disconnect, as I'll call it. Here is a headline: markets rally in the face of downturn. So, wow, this is April. This is this past weekend. The number of cases and the extension of the pandemic continues to grow, and yet the market is going up. It's rallying. Another from Friday: stocks rise as the jobless claim jumps again. So you have a metric here that ought to be scaring us all tremendously. The jobless claims jumping to absolutely unprecedented levels, and yet, as we see, the stocks are going up. I'm going to go back again. I want to point out the second interesting feature of this chart. I'm going to say a couple of different things about this chart in this talk, but the VIX spiked here in March before the coronavirus had really even taken off in the United States. And as the coronavirus cases began to skyrocket, the volatility was starting to come down. This is a peculiarity that is not unique to this situation at all, but it's highlighted in this situation because of the extreme nature of the events going on. People are seeing an increase in the disconnect between how we expect the economy to perform and what the stocks are doing. There is I think, a reason for this. The reason is that the stock market looks forward. Now, I'm going to show you a couple of charts here that are a little bit intimidating, perhaps, but let me try and talk you through it. This is the last crisis in 2008, 2009. You can see here the crash. It's all calibrated. It's a kind of a funny chart. It's calibrated on the moment when the crisis turned around in the market, which happened to be March 9th, 2009. So this is back 6 months earlier, 8 months earlier, in the summer and in the fall, as you may remember, 2008. The market collapsed, fell by more than half, or roughly half, and it hit the bottom on March 9th, 2009. And this was accompanied in this whole area by a recession, a very deep recession. We had unemployment over 10%, and the worst recession at the time since the Great Depression. That recession wasn't over when the market turned. The recession didn't officially end until the summertime, but the market turned ahead of it. The message is that the market moves. The market looks forward. Now here's another chart that's even more complicated, but I'll just summarize it for you and say this blue line in this case is you could call it the valuation formula calculation that the market is applying to stocks. Even before the market turns, it is starting to value earnings more than it had been previously. And that happened 8 months before the end of the recession. Excellent example of the forward-looking nature. And here again, I'm going to show you this chart. The VIX is coming down. Before, in fact, while the pandemic is raging, the VIX is coming down. That's an indication that the volatility is starting to come out of the market, perhaps. We don't know. And That's the first point I want to make about this type of crisis, is that the market is looking forward. It's looking past. People estimate at least 1 or 2 quarters, maybe 3 quarters out. That's where it's looking. It's looking at where as the cliche from ice hockey goes, it's looking at where the puck is going to be, not where the puck is. The second message that I want to make, second point I want to make, is that a lot of the selling that's going on is not selling because people want to sell, or that they think that the economy is necessarily as bad as all that. They are being forced to sell because they borrowed money to create their portfolios. And when the value of the portfolio goes below a certain trigger level, they're required to put in more money, which usually the way they do that is by selling part of the portfolio. So they sell not because they want to, but because they have to. There's a forced selling going on. And a lot of times as well, they can't sell what they'd like to sell. They have to sell what they can sell, meaning the easiest things to sell in the market, the most valuable, the least risky, the safest. So they're selling their best stuff a lot of times and not able to sell the less good. That you can see in this graph, which again is a little bit intimidating perhaps, but let me just broad brush it for you. What this is saying is that there is a sudden rush to cash, that these portfolios, these are professional portfolio managers, are selling as much as they can to get in cash. This is forced selling in many cases. It happened back in 2008. It happened now again in 2020. And one of the things that happens when you have forced selling is everything starts to move in the same direction at once. Bonds, stocks, gold, real estate, every asset class. And that's called correlation. Correlation jumped to its highest level in many years, 90%. That means 90% of all the products that you could buy in the financial supermarket are moving in the same direction right now. Very crazy market. A third point I want to make generally is that technology has come into this market in a big way. It is now, these are algorithms, computers basically running trading programs that they're designed by humans, of course, and they are supervised by humans in some general way, but they run by themselves. They look for certain signals, they look for buy and sell signals, and they execute. And they execute at the speed of a computer rather than the speed of a reflective human being. And these algorithmic traders are now about 50% of the market. There are different ways of counting it, but they're an incredibly dominant force in the market today. Most of these algorithmic traders are trend followers. They look for a trend in the behavior of the market, and they project where it's going to go, and they try to follow it. That's great as long as the trend is going. But at some point, the trend changes, reverses. Everybody may be following the same general trend, and when the trend changes, what do they have to do? They all have to switch directions at the same time, run to the other side of the boat. They all try to, in many cases, sell their existing positions. That is called a crowded trade, when everybody has got to sell and tries to sell at the same time. Crowded trades create volatility. They create crises in the market because liquidity vanishes. If everybody is trying to sell, no one's on the buy side. No one is buying. So what happens? The price movements become very violent. there are also some segment of the algorithmic trading, the so-called high-frequency traders, are functioning in the middle of the market as what are called market makers. I'm not going to go into that in much detail, but what happens is when this type of crowded trade takes place, they pull out, they get out of the market. They are no longer ready to buy and sell and cushion the movements of the market. So volatility soars and the whole market becomes even more violent. Now, what can we do about this? What is the potential usefulness of this information? Well, this is a stock. This is a bank, one of the larger regional banks in the United States, PNC. Look at their recent stock price. They were trading 140, 130, 140, 150, 160 in a fairly smooth pattern. And then they fell with the market down below $90 a share. Now, they were not alone. The whole banking industry, which is represented here by the thick blue line, the light blue line, fell about 40% in the space of a few days. 40%. Now that is the type of movement that you see in these panicked markets. And this is the opportunity. This is, did the banking industry of the United States suddenly lose 40% of its value? No, it didn't. That's what I'm going to say. But I think a lot of people would agree. It is an industry that is much stronger than it was in 2008 because of a lot of regulation and improvement of their capital position. They did not lose 40% of the value. JP Morgan, Citibank, Bank of America, they didn't lose 40% of their value in a few days. This is forced selling. This is algorithmic trading, jumping on a trend change, forcing down the price. And this is the kind of thing that investors actually wait for, many of them. So if we just kind of look at this chart here, we have a pre-crisis value of, let's say, $150 in the case of PNC. We have a crisis value where it sits today around, right now today, it's about $100 a share. And we can project as this where the oil industry charts are showing us what happens in the market. Yeah, you can, the May delivery of oil has collapsed below zero, but the November delivery is projecting $35 a barrel. That's a recovery value. So this is a very common pattern in the market. It's accelerated by technology. Here it is, by the way. This is the S&P from just a couple days ago. And you can kind of see the outline of the thing. It doesn't mean that it's not going to dip again or bounce around. That's the nature of the market. But there's a big pattern happening in the market right now that a lot of people salivate over. And the impact of technology on all of this is that it exacerbates volatility, but it basically drives speed. All the processes in the market that might normally happen at a walking pace now happen at a running pace, a sprinting pace, a race car pace. And the market clears more quickly. Yes, it gets whacked and the bell rings, but the bell ringing is perhaps tamping down and the investment opportunities are sitting out there. Here is, again, the fear gauge easing off, as they say. And this is the pattern that investors like our friend Warren Buffett live for. There are two opportunities, at least, embedded in this situation. One is the pre-crisis value, I'll call it, that is where PNC was sitting before the asteroid hit, the pandemic hit, and drove it to a crisis value where it's sitting today, maybe around 100, 110. Don't really know where these lines are exactly, but you can kind of have a feeling for it. And there's an opportunity right there in the overshoot, which you would have seen in the previous slide, the deep overshoot followed by some partial recovery. That's one investment play that some people get excited about. But Warren Buffett is really all about the bigger play here. Let me get my full screen. Where, let's take PNC again. If they were trading at $140, $150 a share just a month or two or three ago, chances are they haven't been damaged all that much. That this whole thing is a bit of an overreaction, but also as they fix things, as other people fix things in the economy, as the stimulus comes in, there'll be a new value set, and this is the value that Warren Buffett chases when he can find it. And I have there again, you can kind of see the pattern. And I have, to wrap up, a great quote. Warren Buffett is a great quote machine. I will give him that. And this is a quote that he made a couple of years ago. Every decade or so, dark clouds fill the economic skies. They will briefly rain gold. When the downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. In other words, in the crisis, when you see this downturn, that's your big chance. That's your opportunity to make the kind of money that he has made in his career. So that's a very quick overview of the markets, the behavior of these very strange markets and the oil market today. I have to say again, I don't think you're going to see a more shocking piece of financial information ever than oil selling at a negative number. So anyhow, I'm wrapping up. I want to, however, I can't leave without plugging my own products. I've just last month released a new book called Price and Value with Springer A Press. It's available, of course, on Amazon and from Springer. And it's not up to date with the COVID crisis, but it is relevant in a lot of ways, I think. And as to being up to date with the COVID crisis, I've also started just last week. I've been invited to become a contributor to Forbes, and I've posted my first posting on the COVID crisis. I have another one that I'll be posting today or tomorrow, and probably one a week or so. They're not all going to be about the COVID-19 crisis, but anyhow, it's out there. You can Google my name and Forbes, and I'm sure you'll find where it is. Okay, I'm going to wrap it up there. It's about reaching the half-hour point, and I hope everyone stays safe and that this has been a useful survey of the topic.